Silver had hit a peak just above around 30, pulled back, and then in May shot up to 32.75. So it was even stronger than gold following that March annual momentum breakout that we had on the miners in silver and gold. We were pretty convinced it's going to happen. The technicals are behaving too well, too much in line with those situations in all contexts. No matter which way we look at this thing, we come up with the same conclusion. We're in the acceleration phase, and the final dramatic part is about to happen.
Silver has been among the best performing asset classes year to date, outperforming gold. While it has given a return of 24.7%, the yellow metal has notched up 17%. While gold is fighting for support at higher lows, around $2,400 an ounce, silver is struggling at around $29 an ounce. Silver's underperformance compared to the yellow metal has pushed the gold-silver ratio to its highest level in 2 months, back above 82 points. Michael Oliver from Momentum Structural Analysis compares the gold and silver markets, saying silver hit a peak just above $30, pulled back, and then surged to $32.75 in May, showing even more strength than gold following the March annual momentum breakout observed in miners, silver, and gold. He believes we're in the acceleration phase of silver, and the final dramatic part is about to happen. Looking at the last 3 rate cycles in 2000, gold went up 57%, but silver went up 65%. In 2006, gold went up 235%, but silver went up 318%. And in late 2018, gold went up 69%, but silver went up 101%. The gold-silver ratio has jumped 14% from its multi-year lows seen in May. September, silver futures last traded at $29.185 an ounce, down 0.45% on the day. Meanwhile, August gold futures last traded at $2,405 an ounce, up 0.43% on the day. Oliver's long-term measurements of the silver-to-gold ratio suggest that in a typical bull market, gold could see an 8-fold increase from its bear market low to its bull market high, potentially reaching $8,000. Given an $8,000 gold price, silver could experience substantial gains. Oliver is confident that between now and October, silver could show impressive performance, potentially not stopping at $50. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
The lagged gold miners, which had not gone sideways, they'd gone down during those years, and silver, which had gone down from 2021 high to 2023, had the same type of structure on annual momentum that gold had, meaning an easily definable square range. And they both broke out at the same time as gold, basically late March. At that time, our buy signal on silver was 25.17, I think it was. Which if you close a month above that, you're gone. Well, that didn't mean anything on a price chart of silver because you'd had plenty of highs up 26, 27, 28. But in March, yeah, you can see, you go back to August, it looks like 20.
Go back a little farther out.
Yeah, there you go. You see the multiple highs that are the cluster just above 25. Actually, you've got, those must be weekly closes, but most of those highs actually intra-week were 26 plus. Okay, came up through 25 and you gushed up over 30. Pull back, and then you shot up to 32.75, while gold was still going sideways, starting from April, May, June, and July, either side of 2400, excuse me. Silver had hit a peak just above around 30, pull back, and then in May shot up to 32.75. So it was even stronger than gold following that March annual momentum breakout that we had on the miners in silver and gold. And in fact, if you go back and measure year to date, measure from a February low, which was a pullback low in all the metals, silver's way up more on a percent basis than gold is, despite its recent pullback. Even with the pullback, you're still up more than gold is measured from those pivot points. And so are miners, by the way. So we've seen a shift in these initial 3 months of that surge, March, April, May, June. Okay, boom, 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 where it sort of shocked people. Something had changed in the tenor and tone of the market. What they'd been used to is a trading market where you could apply all your little simple on your screen trading tools to trade in and trade out, and trade in and trade out. It was a range bound, happy situation. But what happened in March said, no, it's over as far as we're concerned. It's over. The range bound stuff is over. The pause, the multi-year pause in the bull trend is over. We're resuming an aggressive bull trend. The question is, where are you going to go on the other side? And I don't know. There are long-term measurements of the ratio of silver to gold that suggest that, if gold goes to a normal bull market peak, and by the way, gold normally has 8 full bull markets. You measure from bear low to bull high, at least they're 8-fold. Well, we're only double plus. You have an 8-fold to go to $8,000 gold. Now, what in the world could cause that? There's a lot of things out there that could cause it. Okay. They're all happening right now, even. And you're not going to incrementally go there. Now, if gold ever went to 8,000, silver went to a normal percentage relationship to gold, which, in the last 50 years, silver's been 2.5% of the price of gold, probably, 10 times. 10 different years at the 50. It's been to 2% of the price of gold, 25, 26 years out of the last 50. Well, do 2% of 8,000. Okay. You could go off the page. I don't know where the target is, but I think that the next 3 months, starting next month, but in other words, between here and October, prior to the election, I think silver could do things that would be, frankly, awesome. And unfortunately, I can't put a tag on it except to say, I'm very confident that you come up out of this zone, you're not going to stop at 50. And then it's white knuckle flight because nobody then has a reference point. Yeah. The price charts jump off cliffs. They don't know where's it going. They have no idea. Okay. Only momentum will help us at that point. But again, following what's happened twice before in the last 50 years, what I just described could easily happen again. And so far, it's happening almost month by month the way it did in those 2 occasions.
Because the U.S. government is running substantial budget deficits, the U.S. Treasury is borrowing heavily at its regular auctions of Treasury bills, notes, and bonds. Nearly $1 trillion of additional net issuance in the first 6 months of calendar year 2024 alone. The U.S. government's growing appetite for borrowing and occasional hiccups in the $27 trillion market for Treasury debt prompt occasional concerns that investors may someday balk at lending to the U.S. government. Oliver highlights T-bonds, which have been tracking gold fairly well over the past few years. While both ran up to late last year and then pulled back, gold surged ahead again, whereas T-bonds have remained capped off slightly above 120. He predicts that these markets are about to become very dynamic, joining gold, which is already in an upward trend, leading to a noisy and active period for core asset categories starting soon. Let's now turn our attention to the video again.
There's two markets to watch now because silver and gold have already engaged as far as we're concerned. They gave the big buy signal back in March. Okay. We're not debating that at all from our technical perspective. The stock market's still going up, but we think it's topping right now. In fact, you drop about 4% from where we were Friday, and I'll pound the table and say that was the top. You had a teasing 6 months out above the 2022 price highs on very few indices, by the way, S&P and NASDAQ due to a few stocks, shifting its trend. Then look at T-bonds. T-bonds had been tracking with gold fairly well over the last couple of years. They got out of sync by a few months, some months ago, where both of them ran up to late last year and pulled back, but bonds stayed low. Gold surged ahead again, whereas bonds have stayed capped off. T-bond futures, for example, slightly above 120. They keep getting capped off there. T-bonds look like they're ready to come up out of the hole in a big way, meaning yields drop. Now, again, I'm not talking a long term. I'm talking something that may happen and transpire within several quarters. That's all. Major counter trend move in bonds, drop in yields. It looks like that's about to happen. In fact, you close out this month about a point and a half above, about a point and a half above where you're trading right this minute. We got a breakout. T-bonds are breaking out and joining gold. So there's another major asset category that's about to crack through something. In this case, an upside breakout level on momentum. The other one is the dollar. You mentioned the BRICS. Dollar index has been the dullest it's been in many years, starting from, you're going to flip up a chart there?
Yep, pulling it up.
Okay, good. Let's wait for that.
All right. And here is our dollar index chart.
Okay, now back in 2022, which you don't show, we were up at 115 on T-bonds. Yeah, there you go, that spike. And when you collapsed into early 2023, you can draw a line sideways from that first low in January 2023, and you have oscillated either side of that thing for a year and a half now. Minuscule single-digit percents either side of that low that occurred in January 2023. So the dollar's gone nowhere. So in other words, here's a major asset category, the large currencies. In this case, it's the inverse of the euro, basically. Euro is 57% of this index. The yen is like 17%. Dollar's going sideways. In other words, it's been the quote we call the quiet one. You always got to watch the quiet one. He's the guy that's going to upset you. He's been very quiet. Now we dropped down, we're 104.36 right now. We broke through enough long-term momentum factors 2 weeks ago, breaking through 104.40. And we closed last week below 104.40 as well, where one of our metrics is already broken, but we're waiting on quarterly momentum to break. And that's when we measure each month in its relationship to a 3-quarter moving average. If you close out this month or next month, any month this quarter, below 104.05, we've traded below there. We argue that this zone of quietness you've seen here for a year and a half is gone. We're going to go down and go down pretty sharply, meaning here's yet another major asset category, a tectonic plate. So we think we've got the stock market and dollar both ready to break down. We've already got some indications from stock market and the dollar that they're starting. T-bonds are poised just below a major upside breakout level. So we have 4 categories here. The monetary metals, the bonds, the dollar index, and the S&P or the NASDAQ 100, all ready to crack through significant momentum trend structures that say they're about to become dynamic in a different direction, thereby joining gold, which is already dynamic in the upside direction. So we think it's going to get real noisy across the board in terms of the core asset categories starting real soon.
Around 60% of the total demand for silver comes from industry. Industrial demand has increased considerably in recent years. Silver's usage in green tech is propelling its industrial demand, especially from the solar and electric vehicle sectors. It also finds usage in high-end electronics and 5G technology, says Vikram Dewan, head commodities and fund manager, Nippon India Mutual Fund. Do you believe silver will outperform gold in the coming months? We want to hear from you. Feel free to leave your thoughts in the comments. Give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.